And yeah, so I have been working in the financial industry for about 8, almost 9 years now. So the information we have here for you, it's for informational purposes only. We want to make sure that you feel comfortable starting these conversations amongst you, with your parents, with your peers. So as Courtney said, we will be taking questions. If there is something that I don't know, I will find the right person and I will get you an answer. So yeah, so let's go ahead and get started. Thank you everybody for joining us today. So that yeah, the title is Money Concepts for Teens and Young Adults. And today we will discuss the financial topics that matters to students as they journey through high school, college, and beyond. Here's an outline of what to expect today. The first one will be your first job. What will that first paycheck look like? So I know most of us in high school will be getting our first job if we haven't already done so. So we'll talk a little bit about that. Now, big decisions. Are we going to college, trade school, getting full-time jobs, part-time jobs? What's going to be next after high school? Paying for college. How can I pay for college? Can it be done? And then your college years, can you afford more than ramen noodles? So we want to talk about that, make sure that we get you on the right track. And then, of course, banking and establishing credit, which are my favorite topics. So yeah, let's go ahead and get started. And chat's open for any questions. Courtney, I'm going to ask if you can please just monitor that and make sure that we get to those questions. Now, your first job. So your first 2 weeks of work are over and your boss has just handed you an envelope. When you open it, you might be in it for a shock. I know I was when I got my first paycheck a few years ago. Now, in your mind, you might have calculated, if I work 25 hours this week and I'm getting paid $15 an hour, I'm going to get a check for $375. But for some reason, your check is for less than that. Now, before you go to your boss and complain, let's clear some things up. So the amount that we're talking, the 375, that's what it's called. It's known as your gross pay. That is just the hours times the rate. Now, the amount of money that you can actually cash your check for, it's called the net pay. The net pay equals the gross pay minus any deductions. And I can tell you that anybody here that works for a company usually cashes a check with a net pay. So the gross pay minus the deduction. So deduction is any money that's taken out of your paycheck to pay for employment benefits and taxes. So taxes can include federal income taxes, state income taxes, Social Security, and then some cities actually charge additional taxes. And some common employment benefits are health insurance, disability insurance, and retirement or a 401k. Now, some of you will be covered under your parents' plan, which is great, but you won't be able to be covered by them forever. So usually there is a cost for the employee to have these benefits, and this is where you pay them from. Disability insurance provides income in the event that you become disabled while working. And then the retirement or pension plan, you may be able to contribute money to a retirement plan that your employment sets up for you. Now, once you take all these deductions into account, you will find that your net pay may be only 70 or 80% of your gross pay. So it might be the 375 minus 30%. So let's turn our attention to manage that 70 and 80% the best way that we can. And that's when we want to talk about the spending and saving habits. So in order to know how much your paycheck should be deposited against spend, it helps to have some financial goals. Goals can be broken into short-term goals and long-term goals. Now, a short-term goal typically are goals that you want to achieve within 3 to 12 months, like having money for a concert at the end of the summer or for that new tablet, just something that you want to achieve within the next 3 to 12 months. It might be a little bit different for everybody, so just think about a short-term goal that you might have within the next 12 months. Maybe pay for your prom ticket, for your prom dresses, tuxedos, fun things like that. Long-term goals, so it's going to be how are we going to pay for college, maybe your first car. So long-term goals are something that may take you more than a year to accomplish, like saving money for a new car, like we mentioned. A savings account will make it easier to reach your goals. If you don't have a savings account yet, consider opening one. I know many credit unions offer you special accounts just for teens. I work for a credit union. I'll go into that at the end. But just think about maybe starting a savings account if you're already working, or even if you're not, because in a savings account, there's usually no fees. And you can just put the money there that you get from your parents or for birthday money, things like that. Now, in order to accomplish your goals, you will want to make sure that these goals are SMART. So I remember, and I love that we put this slide into this presentation. I was in college when I learned about SMART goals. And I love that they make so much sense. So a SMART goal has to be specific, measurable, attainable, realistic, and timely. Now let's talk about that. Specific is your what, where, when, and how. The more specific you can be, the better. So let's go back to your prom ticket. So you want to save for your prom ticket. When? In 3 months. How? You're gonna save $20 every month or something like that. Measurable. So determine how you can measure your progress. So again, like in this situation, will be in 3 months. Attainable. Good goals should be challenging but not impossible. So what do I mean by this? Attainable. If I'm making $200 a week and I want to save $1,000 in a week, that's not attainable because I'm only making $200. So we need to make sure that that whatever goals you have are attainable towards how much money you're making. Now, realistic, again, your goal should be something that matters to you. If I'm not going to prom, I don't want to save for prom. Why would I save for something that's not realistic to me? And then timely, set a time frame to accomplish your goals to keep you focused. Now, hope that makes sense. Anybody, any questions? Maybe does somebody want to share their SMART goals or something that they want to save for? Remember, you can drop it in the chat so we can have that chat going and get everybody sharing their goals. Now, if you're going to try to set aside a certain amount per paycheck, consider creating a budget. Now, a budget is something that we want to take into consideration. And for this, it doesn't matter if you are working your first job, if we have parents here who have to take care of bills, kids, rent, bill, like phones, anything. So we want to make sure that you create a budget, which is essentially money in against money out. So some typical expenses for money includes money for goals, savings, gas money, food money, cell phone, entertainment, clothing, personal care items, and gifts. So these are just different categories that you can include in your budget. Again, if I am a teen with no bills, maybe I won't include my bills on this. But if I'm a parent who already has to pay those bills, that those get included in my budget. Now, keep in mind that the money in doesn't have to come strictly from your job. This would include any money you get from an allowance, gifts, and then when creating your budget, get your parents' input as well. Now that you're working, or if you're going to be working, they may have certain expectations about which expenses you will now have to cover. And then once you determine your income and your expenses, you'll need to make sure that you're on track with your spending. Okay, so this is why the budget is important, because it'll help us keep on track of our spending. And then track your expenses. Have you ever had a lot of cash one moment and then a few days later or a few hours later it disappears? I know it happens to me most of the time on paycheck on payday. If you're left to and then you're left to wonder where it went. So tracking what you spend your money on will help you decide if your spending is in line with your goals and your plan. Remember, if your income or expenses change, you will need to revise your budget. So if you have something unexpectedly happen, it's okay. Things happen. So you just have to go back, recheck your budget so that you can keep that, so that you can have that feeling of control over your goals. Some people like using a simple notebook to keep a diary of sort of like to track their spending. And then don't forget about technology. There are many free smartphone apps that make it easier to track your spending. If you go to the app store, you can just look for like expense manager, and then you'll see those there too. But if you prefer to write them down, please do that. Look for something that's gonna work for you. And yeah, that's gonna make a huge difference, you'll see. Now, buyer's remorse. This is, yeah. So buyer's remorse. So it's impulsive spending can ruin your budget. So even when it looks good on paper, think ahead of a time how you will prevent it. So buyer's remorse, does anybody know what buyer's remorse is? Maybe some people, yeah, we do. Okay, perfect. So if we know what that is, that means that we probably have experienced it before. Now, how can you prevent this? Maybe carry less cash with you when you go to the mall. Maybe turn away when you're walking out. Like, those like the stands that you see at the end of the grocery lines, or I don't know, all the stores have them. Those are specifically and strategically placed there for you. So that once you're leaving, you can just grab something. Wait 24 hours before buying. Yes. So that's one of the ideas. Wait 24 hours before buying. If you're gonna buy something big, and I know this has happened a lot before. I have seen it. A car payment, it's a huge investment. It's a huge commitment. Think about it twice, 3 times, 4 times, because there's no buyer's remorse when it comes to something like that. So yeah, so something to consider. Somebody mentioned take some time, so let's do that. Now, big decisions. So a lot of us are, I'm not sure, but we're in high school. Do we have any seniors in the house? Seniors, yes, no, raising hands. Now for when it comes to your big, yes, perfect. So we have Susanna. Awesome, Susanna. Exciting for you. So what are your options? And again, we're just here to give you information. We want everybody to be successful when it comes to what's next after high school. You can enter the workforce full-time or part-time if we're going to college. Go to a 2-year community college. Maybe you're thinking of attending a trade school or even going to a 4-year college. Now, for those that may not be heading to school right now, maybe you're freshmen, sophomores, or juniors, it's just still nice to know about your options in case you like for when you're ready and when the time comes for you. Now, planning for college is not a one-time event. It can be a long process, but the sooner you start to plan ahead, the better. And some of the plans will include, am I going to get a part-time job? Am I going to be able to pay for scholarships? Maybe start looking for those things so that way when your time comes and you can start getting those applications ready. There are many choices that impact college costs. Location, for example, in-state schools can be much more affordable than out-of-state schools. There can be a large difference between resident and non-resident tuition at some public colleges. Housing, living off campus is usually less expensive than living on campus. However, you'll need to consult with colleges to the college that you decide to attend to confirm that students are allowed to live off campus. Now, tuition. So tuition, same thing. Out-of-state residents, not out-of-state schools might be a little bit more expensive when it comes to tuition. If you attend a community college for 2 years, tuition can be cut significantly as well. Now, any questions on this? And again, we're just putting this information here because we want to start the conversations. We want you to ask the right questions. And I know you have amazing counselors. I work with them. So yeah, so if you have any questions, please reach out to them, reach out to your school, and they'll be the ones they have all the answers when it comes to that. Now, for how am I going to pay for college, right? So things that you need to start wondering and asking, do you have a college fund? If so, find out how much money you can have from it and what rules are for using this money. For example, like some plans require you to go to school in state, while others allow you to use the money to pay for off campus housing. And then scholarships, apply for those scholarships. Susana, this is for you. We're calling your name. Scholarships are funds awarded by a school or organization, church, etc., to help you pay for some or all of your school expenses. Scholarships are often awarded based on academic merit, but can also be for things like community service, things like that. So the money does not have to be paid back. Depending on the scholarship, you may have to attend a certain school. So let's say if you're applying for a scholarship at UCSD, it's because you're going to go to UCSD. But really, apply for those scholarships. I'm telling you because beforehand we have seen it at North Island Credit Union. We offer a scholarship program every year, and we need people to apply for these things. You know, it's money on the table. So yeah, please go to your counselors. They, like I said before, they have all the answers for when it comes to how we're going to pay for college. Other places that you can look for might be your dad's, your parents' jobs or things like that. Your banks, credit unions, your high school guidance counselor is it's a great place to start when looking for scholarships. The schools you're applying to may offer scholarships specifically for their students as well. And the internet, let's go ahead and Google. We Google everything, so let's Google that as well. Just be sure that you don't use any websites that charge you a fee. And yeah, check with local groups you belong to, including your parents' employees, your congregation, or even like I mentioned before, your credit unions. Now grants are similar to scholarships in that you don't have to pay them back, but they're given out on financial need. So they are usually awarded by your state or federal government, and some schools also give out grants. And then part of your part sorry, I need water. Part of your federal financial aid package might include work study too. So in a work study, you have a job set aside for you on campus. Work study jobs tend to have more flexibility if you need to take time off to do school work. So check with your with colleges when you're applying if they have the option for work study. And then student loans. So if you are not able to cover all of your college costs with the options that we have considered previously, then you may have to take out student loans. Student loans are loans borrowed specifically for education expenses. The loans must be paid back with interest. Loans can come from federal government or from private lenders as well. And again, I am going to refer you to your guidance counselor who will be able to answer more questions on that and give you resources. But to get any type of grant or student loan, you will need to fill out the free application for federal student aid, or the well-known FAFSA. So application for this is coming up October 1st. That's when applications start. So fill out the FAFSA as early as possible after October 1st of your senior year in high school. So my juniors will have to start getting ready. Parents, we're gonna need your taxes. And I just want to mention this story from one of the persons that I work with. We need your taxes just because we need to grab the financial information. You don't have to pay anything back for the FAFSA. It is free help that it's given out for students. But we are going to need parents to cooperate and provide those income tax returns. So some financial aid runs out, and later applicants who are eligible may be denied funds due to the lack of availability. So eligibility is good for one academic year, which runs from July 1st through June 30th. Yeah, so fafsa.ed.gov, every year you'll have to fill out an application. Now, once the FAFSA has been processed, you will receive it's called a SAR, Student Aid Report, and it verifies information that you provided on the FAFSA is complete. The SAR also lists expected family contribution amount. So When the officials evaluate the finances, they take into consideration a number of factors, including parental and student income assets, the number of family members in college, and how far your parents are away from retirement age. So that's why we need everybody's information. This data is used to determine how much your parents are expected to contribute. The need then it's calculated as the difference between the expected contribution and the cost of the college you are considering. So this number is critical because it is used to determine your eligibility for, again, grants, scholarships, loans, and then other financial aid. Once the FAFSA has been sent out to the school you apply to, their financial aid office determines what type of financial package they can put together for you. Yeah, so each school that you apply to may offer different package based on its cost and availability for their funds. So if you qualify for substantial aid at an expensive private college, but may not qualify for any aid at a less costly state university. Okay. So again, guidance counselors, they will be happy to answer any questions. I know we might have a few seniors here. Please start getting those applications ready. I think we have, well, it's almost September, so you have a month or so to start getting everything ready for your FAFSA application. Now, if you do want to start working a part-time job, this is how your student budget will look like. As a college student, you're gonna have new expenses, including meal plan, because we won't be living in case you won't be living at home, books and school supplies. So again, big changes. So we create a new budget. It's okay. We understand that from now on, your expenses are always going to be changing. So you're always going to start creating new budget, maybe adding more expenses, taking some things off. So this is what what the regular or budget for a student will look like. Now, make sure not to overdo it, especially if you're taking a full load of classes. Make sure that always schools comes first, and then that's if you're getting like a part-time or even a full-time job. Wherever your income comes from, you will continue to have many spending choices ahead of you. So yeah, so just plan accordingly. And again, if anything changes, we just go back, erase some things, and create a new budget. And now my favorite topics, banking. It's a funny story. Let me just add my story here. So when I was in college, I was a teller. I was a teller at a bank, and it was great. It was a part-time job, and they worked with my schedule. So yeah, I had decided to do that. But I never thought that I would stay in banking. And here I am 8 years later, and yeah, it's like now it's one of my favorite topics. So you never know where you'll end up. To apply for FAFSA, will that be during school senior year? Yes, it's gonna be applications open October 1st of your senior year. Yes, go ahead, Courtney.
And just so our students do know, we have one of our counselors, Miss Psyche, is our scholarship counselor. So she's the one who will be sending out all scholarship information. She keeps a running list of all scholarships available. And when it comes to the FAFSA, our counselors will reach out to all of our senior families. And this Thursday, they're going to be posting some information on Launch Connect. They're going to be sending out a presentation to families that deal with a lot of the things we're talking about tonight in regards to the FAFSA coming up and also scholarship opportunities. So please be aware those things are coming to you starting in September.
Awesome, thank you. You see, and that's what we want. We want to make sure that you guys ask those questions and know and be informed. I know your teachers are here to help you, and they're great at what they do. So they are your first resource. So always, again, we just want to start the conversations and for you to go to them. Yes. Now, checking accounts. So a checking account, I wish I could see the cameras, but can we raise hands if anybody already has a checking account with us? Minors or parents? Raise of hands, reactions. We have a reaction thing, so I'm gonna raise my hand. I'm gonna lower my hand. Awesome. So we do have a few. Perfect. So a checking account, we just call it a checking account because that's what the name is now, but it's just pretty much an account that is connected to a debit card many times, and it allows you to make purchases or payments from your debit card. So money, everything that you do out of debit comes out of a checking account. It does make managing your bills easier and allow you to avoid having to carry too much cash, which is always one of the perks, because if I lose my wallet and my debit card's in there, I can just replace my debit card. But if I have $20 in there, I'm not able to replace my $20. Now, if you haven't opened a checking account yet, maybe it's time that we consider to start doing that. Many credit unions and banks have free or low fee accounts specifically designed for students. I know that we do. As a credit union, we are not charging any fees. We don't require minimum balances or nothing like that. And the great thing is that a parent has to always be in the account with the minor. So that way, if they need to add money to you, or, just kind of like make sure that you keep track of your expenses, it's always good to have somebody with some experience on the account already. Having a checking account is a big responsibility and a great way to establish a relationship with the financial institution. So that is, if you're 13 years old or older, you are already eligible to open a checking account with us and with most credit unions and banks. So something to consider definitely. Now, a savings account. So a savings account is a little bit different than a checking account. Like we mentioned, anything that you're spending, making payments from is coming out of your checking account. Now, your savings is money that we don't want to spend, money that we're putting aside. So a great tip to start saving is putting aside 10% or more of your earnings into the savings. So if I'm making $200 a week, I'm going to put $20 into my savings. You might have different saving goals to consider. For example, emergency savings. So 3 to 6 months of your living expenses in a separate account in the event that you lose your job or, something happens. This is where your emergency savings comes in. Goals. So if you have a long or short-term goals, remember those, you may want to set up separate savings accounts to help you track your progress as you work towards achieving these goals. For example, I want to buy a car, we want to get that prom ticket or whatever it is. Make sure that you are putting that money into your savings account. And then, of course, the big one, retirement. Even though you're young, it is never too early to start saving for retirement. But even our parents, maybe it's time that we start looking at our retirement options. Check with our companies. Many times companies match your 401k contribution if they offer it. And even if they don't, it's always a good idea to just put money aside for your retirement as well. It's always a good idea to meet with a financial planner as well. We do offer financial planning at North Island Credit Union, so that's always an option too for our members. Any questions on the difference between checking and savings accounts? Remember, this is a safe space. No questions are dumb questions. We are here to answer them, so please let us know. Now, credit. Ooh, establishing credit. So why is credit important nowadays? Employment. Many times nowadays, employers actually run a credit report too once you are given an offer of consideration. Renting an apartment. We're not even talking about buying a home. Just renting an apartment, landlords are running credit now to make sure that you qualify to lease their property. Also buying a home or a car insurance rates, and then just the interest that you paid when you borrow money. So what is credit, right? So at the end of the day, credit is a way of having something now and paying for it later. And it just pretty much gives the company or the lender, lets them know, or it shows them how trustworthy you are when it comes to paying them back. Now, if you're a student who is under 21 applying for a credit card, you will be required to obtain a cosigner. So many times, and we'll talk about this, but many times when you are starting or starting to establish your credit, banks or lenders will ask for a cosigner or somebody in the application that can be in the application with you, most likely a parent. We are looking that they have good credit or you will be required to prove you have like an independent source of income as well. Now, this is designed to protect you from getting into a lot of credit card debt before you even graduate college. And credit, it's not bad. Let's break, the cycle. Credit, it's not bad. It's something that you have to be very careful with, and you have to make sure that it works for you, because it can be expensive. Now, using a credit card responsibly is one tool to build credit, and we'll discuss responsible use of credit in a little bit as well. But there are other ways you can help yourself establish a good credit history. For example, there are things called secure cards or secure loans. So a secure credit card, it is backed with your own money. So for example, you put $300 and then you get a credit card for $300. So even though you are putting your own money to get it started, it is just being used as collateral. Why? Because again, we don't know if you're going to pay us back. And I'm talking lenders, right? They don't know if you're going to pay them back because you don't have any credit history to prove that. So what they do, they use this money as collateral. But if you create a good credit history, if you show that you're making your payments every month and things like that, what they're going to do is they're going to give you your money back, because now they trust you as a member, now they trust you as a customer, and they're going to just give you a regular credit card. So now loans, it's kind of like the same thing. Secure loans, you make a deposit that's used to make automatic payments to pay back the loan. So it's the same thing. You're putting your own money, you are building that credit history, not only with the bank, but also this is going to your credit report, and we'll talk credit report in a little bit. Now, retail or store cards, they're usually easier to obtain than a purpose Visa card or MasterCard, just because those cards have a higher interest rate in excess of 20% APY. So be sure if you can pay any balances off in full. What this means is if you spend $100 in that credit card, make sure that you are paying it back at the end of the month. Again, sometimes, and I would always say this to my new members, to my new customers, to people starting their credit, a credit card, it's not a gift card. And it can be easy, because you have the card in hand and it's easy to just swipe. Credit card, it's not a gift card. Anything that you put on that credit card, you'll have to pay it back. So think about it. Am I able to afford $5,000 right now? Or can I only afford $100 to make my payments back? So, you're going to be working with your budget. And this is what happens. And this is why a lot of people are scared of credit. And it's completely understandable. But remember, it's something that you have to make sure that that it works for you, as long as you know how to use it responsibly. Other ways to establish credit, piggybacking of someone else's credit card, but you have to be very, very cautious with this. So, for example, one of the options will be getting a cosigner or a joint account. When you are co-signing with someone, both parties are legally liable for the debt. So meaning that if my dad or my mom co-signed with me on my first credit card and I spend $3,000 on that credit card, they are responsible for paying that back. I can just say, oh, I'm not gonna pay it back. It's not. It's like I'm tired. I don't want to pay it. I can't afford it. My parents are going to be responsible for that. So we need to make sure that, again, we are only spending what we can afford to pay back.
Nancy, there's a question in the chat for you. It says, is there a good rule to follow in spending with regards to credit cards?
Yes. So lenders want to see 30% of less of your available credit being spent on the credit card. Now, if I have a credit card for let's say $1,000, they want to see that I spend less than $300 on it. But it goes back to the same thing that we were just talking about. Am I able to afford the $300 on that credit card? At the end of let's say if I went ahead and I bought my purse and now I owe $300 on this credit card. What's going to happen? I can only pay the minimum payment. And all credit cards will have a minimum payment, usually $25, $40. Now I can afford to pay the $25, right? So I'm gonna get my bill and I'm gonna pay those $25 back. I still have a balance. It's what it's called a carryover balance of $375. I'm sorry, $275. What's gonna happen is the bank, it's gonna charge me interest on the $275 that I carried over. And now next month comes, and I also, same thing, this month I was only able to afford the minimum payment. I'm gonna give $25 more. Now, what they're gonna do on the they're gonna do the 275 plus interest, right? So let's say I'm out at 20%. They're charging me interest on the 275. I give my $25 again, but I'm not paying it off. I still have a balance on that credit card. What's gonna happen is they're gonna charge me interest again on like $260. So that's why it's gonna feel like it's gonna take me a long time to pay that credit card. And then this is a perfect scenario here. So if I spend $1,000 on my credit card and my APR 14.99 and my minimum payment, which is the only thing that I can afford, it's gonna take me 6 years and 10 months to pay off the $1,000 that I spent. For only because I'm only affording the $30 minimum payment. What this means is I'm spending $507 of interest on a purchase that was only $1,000. So to go back to the question, the rule, lenders obviously lenders want to lend you money, right? We want you to pay us the interest. We want to make sure that we stay in business, and this is how banks, how credit unions, how everybody stays in business through the interest. Now, the rule will be only spend what you can afford. But it goes to that. So let's look at this other scenario. $5,000. So I went ahead and I found out $5,000. I don't know on what, with my APR of 14.99 at a minimum payment of $150. It's gonna take me 14 years and 5 months to pay back those $5,000 plus the interest. So I'm paying $3,361 in interest. So this purchase that was originally $5,000, let's call it, I don't know, some really fancy shoes. Now it's costing me $8,361. So is it worth it? Let's see. I have a follow-up question, I believe. Do I need
The follow-up question says, so is the general rule to keep my balance at 30% month to month? Do I need to maintain at 30% each and every month?
Yeah, so your credit score, it is actually reviewed every month. So yeah, so the general rule would be to keep it at a 30%. Obviously, I would say only use it when you need it. It's really up to everybody, everyone's, and this is what happens with credit. If you're able to, because here's the thing, I'm gonna call you John. John, if you're able to pay back that credit card every month, that's much better, because even if a lender pulls a credit report and you have a zero balance on that credit card, it still shows them how many payments you have made. So it still shows them, oh, you know what, the card has been open for 12 months and he has made 12 payments. So they're actually seeing that you are using the credit card, that you are a responsible buyer, that you are a responsible spender, and that you are paying it back. So I don't want to give you I don't want to say yes to your question of the 30%, just because you are paying interest on that 30% month to month. Now, here's the thing. On my scenario, I said $1,000, but what if 30%, it's $10,000 of a $30,000 credit card? It's not a good idea. It's not a good idea just because you are paying interest on $10,000. So this is what I mean by when it comes to really being able to just spend what you can afford. I hope that makes sense, and I'm not just making it a little bit more confusing. So again, in regards to credit cards, let's use them keep them open for emergencies, one-time purchases, something like that. Many times banks will offer you 0% for like a term period of time, so like a promotional period of time. So that's always good as well, because you know that for those 12 months they're not going to charge you any interest. But then make sure that when they start charging you interest, that either that you are aware of what the rate will be, or that you pay more than the minimum payment. So banks will always require you to make a minimum payment, but if you can pay more, even if you bring it below the 30%, do that. Because at the end of the day, you want to make sure that, again, this credit card is working for you, that you're not spending more than you can afford on interest. Now, applying for credit. So again, credit can be expensive if it's not used wisely, and we want to make sure that we do use it wisely. So when reviewing your application for credit, lenders usually use a credit scoring model. So the most used one is called the FICO score, and there are factors used in the model that are commonly referred to as the 3 Cs: capacity, capital, and character. So capacity looks at whether you have the financial capacity to take on the credit you are seeking. Creditors will look at your income and your other financial obligations to determine if you can handle the additional debt. So it goes back to, okay, I'm making $1,000 every month and I already owe $500 on credit cards and loans or whatnot. So lenders are going to see, okay, can this person afford another loan, or this person still needs to have some type of spending money, right? Like we still need to pay rent, we still need to pay taxes and all that. So that's what capacity is, just the ability for you to take on more credit. Capital. So creditors will look for what assets and resources you have. When evaluating capital, they want assurance that a debt could be paid from your assets. It could be a house, it could be your car being used as capital. So yeah, and then character. Character is often the most important aspect of the majority of creditors, just because they want to know how you handle your other debt obligations. Again, let's go back to the other scenario. Are we keeping 30% of that debt, or am I paying back more than the minimum payment? Or am I keeping my credit cards at a zero balance because I don't really need it? They rely on credit reports to determine your character, and they may also verify information provided by you on your application to determine its accuracy. So they might request credit card statements, your income tax, or your pay stubs, things like that, to make sure that you are making whatever money you said you were making. Now, these are just some tips to help you use credit wisely. So having money in a savings account as a backup so that you can handle an unexpected expense without getting into debt using your credit card is a great place to start. Again, credit cards, use them as emergencies. Don't use them as gift cards. Remember that everything on that card has to be paid back. And we want to make sure that the rate that you're paying it back at, it's a good rate for you. Consider only making one charge a month and make this charge an automatic bill, such as like an internet or cell phone. The reason we suggest this is because an automatic charge is, sorry, my notes. You only need to generate activity to build your credit score. So remember how I said when lenders pull your credit report, they can see how many payments you made and all that. So you need to generate activity to build your credit score. It doesn't matter how much activity. So we don't care if you're spending $10,000 or $100 a month. The smaller the balance, the lower your utilization. And as we learned, this is 30% of your FICO score. So setting up an automatic charge ensures that you would not just go into temptation and overspend and get into that buyer's remorse that we talked about earlier. The lower the utilization, the better. A general rule of the is to use 1/3 of your available credit, like we mentioned. And then while paying off an account in full does not improve your credit score per se, paying on time is what really matters. Paying off the balance in full will prevent any finance charges from accruing. So yeah, you can take the 30% with you every month, accrue it over, but you're still paying interest, and that's still not good. We don't want you to pay for something that you don't have to. And then check your credit score regularly. So let's see on that. Your credit score is a 3-digit number that tries to quantify the likelihood of repayment. The higher the score, the better the rates. So it is meant to reflect your credit risk. People often wonder what a good credit score is. So essentially a good credit score is a number that matches the level of risk a lender is willing to accept for a particular loan or credit card. So an 800 or plus will be an excellent credit score. The lower the score, the higher the risk. So when you have a low score, you will pay more to borrow money. And when you have a higher score, you'll be offered a better interest rate, which will cost you less because the lender is not taking as much of a risk lending to you. So let's put just a simple scenario. So if I'm somebody with a 580 credit score and I'm getting a loan for $500, my rate most likely will be super high. Let's call it a 20%. But Courtney is somebody asking for a $500 loan with an 800 credit score. Her rate might be 3%. So I'm paying 17% more than somebody else with the same for the same amount just because my score, I'm higher risk. So lenders might hesitate more into lending to me. There are more than one. I know businesses use a different model. Like when you have a business, I just can't remember from the top of my head, but usually for people, FICO is the most widely used one. Also, when you're applying for credit cards or auto loans, you have your auto loan score and you have your credit card score, just depending on what you're applying for. And that's what, depending on what you're applying for, is the one the lenders use. But yeah, FICO is the one. Any questions on credit scores? Remember, how do we obtain a credit score? We can be added into our parents' accounts, or we can get them to co-sign with us. That will give us a credit score. You might be getting different FICO scores, but it's the same model. It's just companies will use it differently. For example, just to give you an idea, with North Island Credit Union, whenever you come into our branch to request for a loan, we only run Equifax. So you might have an Experian credit score, you might have a TransUnion credit score, but we only run your Equifax credit report. So if your Equifax credit score is 700, but your Experian it's 800, we're gonna take the 700 one. So it's not that they're different; they're just the model that they use it's a little bit different. But it's still the FICO. Hopefully that answers the question. I don't have that answer, John. So all accounts, your accounts might be reported differently to how do I say this? So this is the model. This is, if you look at the screen, this is what we're looking for when we give you a credit score. So your payment history accounts for 35%, amounts owed for 30%, and the rest. But were you talking about TransUnion and Equifax and Experian when you said that you had different scores? Because if you were, it just means the companies, they're using a different model, and I don't know what is it that they use when it comes to that. They're all different. As lenders, we only run the report. Sorry, I know you're typing, so I'll help you get to it. But yeah, so this is what your credit score breakdown looks like. So if 35% of the payment history, 35% of your score will be your payment history. So make sure that your payments are always on time, even if it's just the minimum payment. Amounts owed, use of available credit. Again, let's try to keep those accounts below 30% if you can. If you can, pay off your balances every month. And then length of credit history. So that's 50%. So when you're new credit, you'll see that your score might just tell you like, oh, it's just because you haven't had a credit for a long time. It's okay. It's gonna take us a while. As soon as you're 18, I always recommend visit your bank, apply at least for a secure credit card just to get you started on your credit report, because this way when you're 25, 26, and you start making those bigger purchases, you'll get better rates when it comes to that. New credit, don't apply for credit too often. It's recommended to only apply for credit twice a year, just to make sure that you don't run your credit more than twice in a year. And then types of credit, a mix of loan and credit cards will help, but don't overdo it. Your income, employment, where you live, race, age, gender, religion, national origin, and marital status are not factors that are not included in determining your credit score. So all those, we don't care your income, your employment. So those they don't determine your credit score.
John's question then says, to prepare for certain important purchases like auto, home, car, what are the models or credit bureaus do lenders use for these particular purchases?
These are the three main ones: Experian, TransUnion, and Equifax. So, but again, you're gonna have a different score. You're more than likely you're gonna have a different score with each of these three. And then that's when it comes to depending on your lender. And again, I give you the example of North Island. We only use Equifax. So if you have a lower TransUnion score, we don't look at that. We just use Equifax. And I'm sure if you're looking at a lender for like a home, they might be different. But they're all gonna look at your credit report and your score with one of these three. And then yeah, so let's just briefly, it's what's contained in your credit report as well as your score is calculated. A credit report is just a record of your credit history. Credit reporting agencies keep and organize this information. The information is provided to them when you apply for credit by creditors with whom you do business and through public records. Yeah, you can ask the lender which one they use, and actually they have to give you a copy. Whenever a lender runs your credit, you are entitled, they give you like, it's called an RVP form, where you can contact whichever credit agency they use, and they can give you your credit report. You can also request a copy of your credit report once a year, online or by mail. The website, it's on the screen. Sorry, we have like 30 seconds. I just want to make sure that I get to this one. Annualcreditreport.com. You can request your credit report there if you need to see what's going on or what do you have, accounts and all that. Correct. And honestly, John, many times it's not even up to us as consumers. It's going to be up to the lender. And you can, like I said, you can ask them which one they use. Like if you ask me, we use Equifax. So if you come to the credit union, if you come to, we're only going to run your Equifax report. We don't run your TransUnion report. It doesn't mean that we don't report it. We're still going to report whatever loan you're getting with us to all of them, but we're only running your Equifax report. And many times, like car dealerships, they might run all three of them because they need to know, like, they're looking for the higher one. But yes, you can definitely ask them which one they're using, just to make sure what it looks like. And again, check your credit report. Make sure that all the accounts that are showing there are valid, that you did open those accounts at some point. Yeah. So, any other questions?
Nancy, is that the end of the presentation?
Yes.
Perfect. I can stop recording. So if people
you.
feel more comfortable than asking questions, let me go ahead and do that.
Yeah. And I just want to say, John, thank